Okay, guys, so I welcome you back to Sir Ernest Asante TV, my channel. If you've been following our class, you would notice that we've treated about four sections already. If you have not watched any of our videos and this is your first time, we want to welcome you onto this channel, and I know that as you are learning, you are going to be blessed. So today we are going to go through one of the interesting topics in accounting, which is the golden rule. The golden rule in accounting, okay, or you can say of accounting or financial accounting, and that is popularly known as the double entry principle. The double entry principle. The double entry principle. All right. This is a principle or rule that was introduced by an Italian monk by the name Fra Luca Pacioli. I've said this before, and with this principle, he had it in mind that every transaction has a double effect. Every transaction has a double effect, both on the side of the business owner and on the other side. It has double effect. So that is how come the double entry principle came about. And in the rule, it says in the rule it says every debit entry has a corresponding credit entry and vice versa. So here Luca Pacioli says that every debit entry has a corresponding credit entry, and when I say vice versa, every credit entry also has a corresponding what? Debit entry. So every debit entry, when an account is debited, that transaction that took place, it should have a corresponding credit entry in another account to make it a double effect. That is what we talk about in the financial accounting to mean the double entry principle. The double entry principle. For example, if I sell a marker, okay, for cash, so marker here, cash, okay, so I'm selling. All right, so we know here's our debit, credit, okay. If we are debiting cash because we are receiving cash, the figure will come here, then the corresponding entry will be here. So it means that this credit entry has a corresponding debit entry, this debit entry has a corresponding credit entry. That is what we say it's a double entry, or the golden rule. The golden rule. All right, the golden rule. Now, double entry is done in an account. Double entry are done in accounts. Okay, this exercise is done in accounts. So what then is an account? Now, if you look at a ledger, let's say the face of a ledger, okay, the face of a ledger, okay, when you look at the face of a ledger, you see that it is divided into two, and it has something like this, okay. So simply you can say an account is the face of a ledger. All right, an account is the page of a ledger or the face of a ledger. So when you look into a ledger, the page, it has a face like this. Okay, that page in a ledger is what we call an account. So we often call it T account. T account. So where every item is recorded in. Okay, every transaction is recorded in. So here we can say an account is the page of a ledger. Okay, what does it do? Which records transactions relating to a person or property. You can call it property or property based on the school that you attended. So we are saying that an account is the page of a ledger which records transaction relating to a person or property. So that T account that you've seen is used to record transactions, and the transaction could be for persons or it could be about properties. Okay, properties, PP. Okay, so that is what we call an account. That is what basically we call an account. And an account has the debit side and it has the credit side. The credit side. An account has the debit side and it has the credit side. So if I draw an account like this, it has a credit side here, it has a debit side here. So when you want to debit the account, and it has a title here. So the title is where you put whether it is cash or what have you put it there. Then it has a debit entry and it has a credit entry. Okay, so that is an account. That is an account. What then are the classifications of account? Classifications of account. Classifications of account. Classifications of account. Classifications of account. What then are classifications? Are the classifications of account? Now we have two classifications of account based on the definition. If you look here, it says that it's either relating to a person or relating to property. You understand? So it means that the account may be in two groups. Okay, one that is in relation to what? Persons, and the other which is in relation to what? The other which is in relation to what? Property. So we have personal, you see the name, we have personal account and we have impersonal account. Impersonal account. So personal accounts are the accounts that are in relation to persons, and then impersonal accounts are accounts that are in relation to what? Properties. So when we say persons like Kofi, Ama, whatever, you see. But the persons, when it comes to accounting, persons can be two things. When we say persons, it's either it's in relation to a name, okay, a name of an individual or a business. So it could be a name of an individual or a business. Also, the only way that person's name will be in our book is if they are either our debtors or our creditors. You understand? So when you see Kofi account, Kwame account, Prosper account, it means that it's either the person is a creditor or the person is a debtor. So that is what? Personal account. Persons, personal account. When you come to impersonal account, we are looking at properties Now, the properties here, we have either tangible, right? Tangible or intangible properties. We have either tangible properties or intangible properties. We have either tangible properties or intangible properties. So when they are tangible, we call them real account. We can see they are tangible, they are real account. And when they are intangible, then we call them nominal account. So ideally, there are three classifications of account: personal account, real account, and nominal account. And then the real and nominal account form the impersonal account. So real accounts, they are the tangible ones. What are tangible properties? The land, the buildings, almost all of the fixed assets are under what? Real account. Now when you come to intangible, the intangible side that we are talking about is normally expenses or income. You can also say gains or losses. They are under the nominal account. Why are we saying that they are intangible? For example, ideally when you say salaries, you don't see salaries. You see the cash, but you don't see the salary. For example, if we are paying salaries, we'll have salary account, and then we are paying by cash, right? So cash will be treated. Salary will be treated. This salary cannot be seen. Ideally, it cannot be seen. So we are saying that it is intangible. It is what? Nominal. When you talk about income, when you talk about expenditures, you see, we say that they are what? Nominal. They are nominal. So that is the classification of account. Now, remember we are talking about double entry, but double entry is usually done in an account. So you will still need the word definition of account and the meanings of account and the classification of account. That is why it is necessary to go over the accounts. Now, this rule has been simplified and classified based on this classification. It has been broken down into understanding based on these classifications. What then is the rule when it is one personal account? When it is personal account, of which this is the most popular one that we normally use in all the dealings of accounting, although it's not right, but we use it. Even when it is not a personal account, you say it, debit the receiver, credit the giver. So when it is personal account, we say that you debit the receiver, credit the giver. You see, debit the receiver, credit the giver. So when it is personal account, debit the receiver. So for example, if we the business are the one receiving, it means that you debit us. If the personal account, maybe Kofi is giving, you credit Kofi. Now Kofi will be our creditor. What about if Kofi is receiving? You debit Kofi because Kofi is now receiving. So debiting it becomes our what? Debtor. You see how it is. So when it is personal account, debit the receiver, credit the giver. Debit the receiver, credit the giver. Debit the receiver, credit the giver. Very known and popular. And this foundation will help you as we go in accounting. What if it is real account? Real account. Remember that it means that they are tangible. Now, remember, these are not persons. So we can't say they are giving. This is debit the receiver because they are person. Someone is receiving. But these ones are not persons, they are what? Properties. But this time around, they are tangible properties. So what then will be the rule? The rule will be that debit what comes in, credit what goes out. So now it is not, although if you use this thing same, it will go everywhere. But when it is real account, we say debit what comes in, because this time around they are not persons to receive. But the item or the property is coming in. So if the item is coming in, like you bought plant, so plant is coming in, then debit what is coming in. Okay, maybe you are selling the plant, so this time around it is not coming in, it is going out of our premises. I always told you that make the business as yourself. So it is coming to it is going out of our premises, then you credit what is going out. So if it is real account, debit what comes in, credit what goes out. If you understand these things, it will help you. Me, when I was learning accounting, I didn't get it this way. It was later that I understood that the foundation is like this. And if you get it like this, personal, what is a personal account, what is not a personal, you will understand as you go on. So that is that. Okay, so next, what if it is nominal account? Then we say debit expenses or losses, then credit income or gains. Okay, so when it is nominal account, always learn to debit expenses like the salary I treated. It's an expense. Okay, the salary is an expense. All right, so you always have to debit expense, and you always have to debit losses, and you always have to credit income, you always have to credit gains. So basically that is what I'm saying. For example, let's look at the rent. We are paying rent by cash, so rent account, cash. Now we are paying rent of 10,000 cedis. Cash is being paid for rent, so cash is what? Going. All right, cash is going. Now remember, cash can be seen, so it is real. Now credit what goes out. So since cash is going by payment, we'll credit cash by 10,000. Now if you credit cash by 10,000, what do you do to expense, which is rent? You debit it by what? You debit it by what? 10,000. So here we credited it, here we what? Debited. Now this corresponding debit entry has a corresponding what? Credit entry. So you see, so we have debited rent and we have credited cash. Yes, we have credited cash. Now the reason why I said that if you see it like this, if you use the first one, it still goes, is that let's say cash is given out. Okay, cash is given out, so let's say that we are paying rent. Okay, cash is given, so if cash is given, cash is the giver, so you credit cash. If we are paying rent and rent is receiving, you debit it. But ideally they are not personal. This thing was made for personal account, but we tend to misuse it, and it still works for us. And since it works for us, but at least if you get the understanding, you'll be able to know the necessity for that rule. Ladies and gentlemen, today we learned golden rule in accounting, which is the double entry principle by Luca Pacioli. And then we said double entry is done in account, and the rule is that every debit entry has a corresponding credit entry, and every credit entry has a corresponding debit entry. We defined an account as a page in a ledger that records transactions relating to persons or properties. Then we said it has a debit side and a credit side, and the debit side records debit entries, and the credit side records credit entries. We talked about the classification of account. We have three of them: the personal, and then the real, and the nominal, of which the real and the nominal are the impersonal accounts. If it is a personal account, you debit the receiver, you credit the giver. If it is a real account, you debit what comes in and you credit what goes out. If it's a nominal account, you debit expenses or loss and then you credit income and gains. Ladies and gentlemen, this is double entry part 1. We will be doing double entry part 2 and part 3, and then we'll move to cash book and the rest. And I've gotten messages from TikTok that we should treat petty cash. We'll get there. Right from cash book, we'll move into petty cash, and we'll be going deep into all the topics in accounting. My name is Ernest Asante. If you have not subscribed to my channel, please subscribe, share with your friends, and let's build an accounting empire. I know that with the help of God, we'll be able to climb the academic ladder. I pray for you, especially if you are a student and you are watching this. If you have any exams closer to you, I pray that God will give you retentive memory. If this course has become difficult for you in the universities and where have you, I pray that with the help of God, you will understand everything that you study and you will pass all your exams in Jesus' name. At least type an amen at the comment section. The Lord bless you.